This Chapter 1 summarizes the principles underlying capital regulation under Basel I and II, including the historical background for the introduction of these two standards, and lists a number of caveats that accompany our discussion throughout this module. When people refer to Basel I or Basel II, or to the Basel Committee, they are talking about the set of rules published by the Basel Committee on Banking Supervision, which is a committee of banking supervisory authorities established by the central bank governors of the principal financial jurisdictions in the world, namely Belgium, Canada, France, Germany, Italy, Japan, Luxembourg, the Netherlands, Spain, Sweden, Switzerland, the UK, and the US. The committee usually meets at the Bank for International Settlements in Basel, Switzerland, where its permanent secretariat is located. The committee is tasked with the promulgation of guidelines addressing the minimum capital requirements of large, internationally active banks around the world, as well as other aspects of prudent bank management, such as liquidity management and counterparty credit risk mitigation. The need for such a committee arose from the recognition that premier banks were becoming increasingly active internationally, whether as lenders, deposit takers, securities underwriters, FX or hedge providers, and a wide variety of other functions, and that to achieve the desirable objectives of leveling the competitive playing field and ensuring a uniform regulatory regime around the world, some cross-national committee should set minimum prudential standards to be promulgated nationally throughout the member countries. As a practical matter, most countries in the world, including the large majority that are not represented on the committee, choose to follow its rules and typically enact national legislation and regulations that are at least as stringent as those of the committee. Indeed, it is rare to find a country explicitly rejecting a standard recommended by the committee and adopting a looser one, but quite common to find countries that implement stricter standards than those of the committee. More specifically, Basel I refers to the compact, relatively user-friendly set of rules issued in 1986 governing the calculation of the minimum capital requirements applicable to a bank on account of the credit risks inherent in its business. While Basel II, which was finalized in 2006 and is at least 20 times as long, addresses also the capital requirements for credit risk, albeit in a much more complex manner, but adds to them capital requirements for market and operational risk. Other important differences between the two standards will be discussed as we progress in this module, but the main ones include the following. 1. Far greater differentiation exists under Basel II with regard to the specific credit quality of the bank's exposures. 2. A single regime existed under Basel I versus 3 regimes under Basel II of increasing sophistication, known as the standardized approach, the internal ratings-based approach, and the advanced internal ratings-based approach. with the more advanced approaches permitting and indeed encouraging banks to rely more on their internal model-based estimates of their risks and less on inputs determined by the regulators without feedback from the bank itself. Third, more specific guidelines exist under Basel II regarding the treatment of complex financial instruments, such as credit derivatives, securitization, and project finance, and regarding the ability to use various forms of collateral to mitigate credit exposure under a loan or bond, or under off-balance sheet items such as derivatives and repurchase agreements. Fourth, in addition to setting minimum capital requirements under what is called Pillar 1 of Basel II, there are two additional pillars in the framework. Pillar 2, which requires the national regulator to work with bank management in monitoring the aggregate risks of the bank and adjusting capital requirements to reflect additional risks for that particular bank that are not captured under Pillar 1. And Pillar 3, which seeks to complement Pillars 1 and 2 and to encourage market discipline by developing a set of disclosure requirements which will allow market participants to assess key pieces of information on the scope of application, capital, risk exposures, risk assessment processes, and hence the capital adequacy of the institution. We now provide a very short summary of how Basel I works. The reason we still talk about Basel I at all, even though Basel II is already in full force in many countries and so-called Basel III appears to be just around the corner, is threefold. First, the fundamental methodology behind the Basel I framework has been retained under Basel II, albeit with enormous amendments and additions. So a solid understanding of Basel I is a useful stepping stone to familiarity with the more complex Basel II. Second, many banks around the world, including in particular a large percentage of the thousands of small local and regional banks in the United States, continue to operate under Basel I or under a barely modified version of it. And third, several key components of Basel I have been incorporated wholesale into Basel II, including for the most part the definition of eligible capital instruments and the so-called credit conversion factors that are applied to off-balance sheet items to derive the loan equivalent amount of the exposure. Basel I can be summarized in 6 steps. 1. Banks must identify all assets on their balance sheet, principally loans and bonds, and must allocate these into a finite number of broad categories recognized under the standard, with no differentiation within each of these categories. Thus, residential mortgage loans form a category. Loans to governments or government agencies of countries that are members of the Organization for Economic Cooperation and Development, or OECD, form a category. Loans to corporates form a category, and so on. 2. A predetermined risk weight is assigned to each item based on its category, with the great majority of items receiving a weight of 0, 20%, 50%, or 100%, although some other weights apply to a few unusual items or in unusual circumstances. Three, the same risk weights are also assigned to off-balance sheet items, such as derivatives, lending commitments, letters of credit, guarantees, and various other forms of funding or purchase commitments, but only after multiplying the notional amount of each of these by something called a credit conversion factor, or CCF. The CCF typically reduces the notional amount to a smaller number that better reflects, in the judgment of the regulators, the average expected credit exposure under the item in question. 4. The so-called aggregate risk-weighted assets of the institution are then calculated pursuant to the following simple formula, which first requires each asset on the balance sheet to be multiplied by its specified risk weight. Second, requires each item off the balance sheet to be multiplied by its specified conversion factor, and then also by its specified risk weight. And third, requires all of these amounts to be summed together to produce the aggregate risk-weighted assets as a single number in units of currency. Five, the total amount of eligible capital the bank has is now calculated and separated into so-called Tier 1 capital and Tier 2 capital. These will be defined in more detail in Chapter 2, but essentially, Tier 1 capital consists of common stock, retained earnings, some types of perpetual preferred stock and hybrids, and some categories of reserves. And Tier 2 capital consists of some other types of preferred stock and hybrids, some other categories of reserves, and subordinated debt that meets certain conditions. Finally, a bank must satisfy the following three conditions under Basel I. Tier 1 capital must be at least 4% of risk-weighted assets. The sum of Tier 1 and Tier 2 capital must be at least 8% of risk-weighted assets. And finally, Tier 1 capital must exceed Tier 2 capital. We complete this brief introduction by mentioning some very important limitations and caveats that you should keep in mind throughout this module. 1. Most of the time we state only the key components of a rule, but avoid a lengthy discussion of some of its more detailed subtleties, principally in the interest of time. For example, a well-known rule under Basel I may be stated in its simplified form as specifying that credit exposures to OECD governments carry a risk weight of 0. A fuller version of this rule, which would still be slightly incomplete, would state that credit exposures to OECD governments and to countries that have concluded special lending arrangements with the IMF associated with the fund's general arrangements to borrow, or to any government agency of any such country, or to its central bank, carry a 0 risk weight, provided the country in question has not rescheduled its external debt in the previous 5 years. We think that the essence of the rule is adequately conveyed by the simpler version and find little benefit cluttering the discussion with the 3 refinements introduced under the second version. 2. We mention only some of the instances in which rules have been adopted differently in different countries, principally those that appear to give significant competitive advantages to banks in some countries over others, or which give rise to particularly interesting opportunities for regulatory arbitrage. 3. We say nothing about the Basel guidelines for market risk, which are exhaustively covered in our separate module on value at risk. 4. We leave operational risk to a completely separate module as well. 5. In our discussion of Basel II, we concentrate on the so-called standardized approach and describe only very briefly the 2 other approaches based on internal ratings models. In particular, we do not, in this module, discuss any of the very detailed qualitative requirements imposed by regulators regarding systems, controls, credit processes, and documentation policies imposed under Basel II on banks intending to implement either of the internal ratings-based approaches. 6. We leave to separate modules the various techniques banks use to optimize their regulatory capital ratios, particularly those involving securitization, credit derivatives, and complex hybrid instruments. Finally, many of the rules we describe in this module are undergoing review beyond what we describe in Chapter 4 and may be amended in the near future. You should therefore not rely on this module for purposes of any actual transaction on which you may be working currently. This brings us to the end of this Chapter 1.